You know, the world of trading can feel like a total maze, right? Just a bunch of jargon and complex charts. Well, today, we're going to hand you the map. We're going to break down the main types of trading in a way that just makes sense, so you can start to see this world with a bit more clarity.
Okay, so when you hear the word trader, what pops into your head? I bet it's that classic Hollywood image, right? Some person yelling into two phones at once with like a dozen glowing screens all around them. But what if I told you that's really just a stereotype? The reality is way, way more diverse.
And here's the thing, the real secret sauce, what really separates one kind of trader from another, isn't always what they're buying and selling. Stocks, currencies, whatever. It all comes down to how they see time. We're talking about a spectrum that goes from mere seconds all the way out to months.
All right, let's dive in at the fastest end of the pool, the intraday arena. These are the absolute sprinters of the trading world. Every single trade they make, every buy, every sell, happens within one single day. Once that closing bell rings, poof, they're done. No positions held overnight.
Now, inside this arena, you've got two main players, scalpers and day traders. They both live and die by the clock, but you could say their clocks are running at very different speeds. Let's break down what makes them so different.
Okay, first up, scalping. Think of this as trading on hyperspeed. Seriously, we're talking about holding a position for just a few seconds, maybe a couple of minutes tops. The whole goal is to skim tiny profits off of almost invisible price changes, but to do it over and over again. This takes lightning-fast reflexes, and yeah, the risk is very high. A big reason for that is leverage, using borrowed money to make bigger bets, which of course means your wins and your losses get magnified.
So if scalping is the 100-meter dash, day trading is kind of like the daily marathon. The positions are held longer, maybe for minutes, maybe for hours, but that one core rule is exactly the same. You close everything out before the market does. The whole game here is profiting from those little price waves that happen during the day, and it really relies on sharp technical analyses and making decisions that are quick but not quite instantaneous.
Okay, let's pump the brakes a little bit. We're stepping out of that super fast intraday world and into strategies that demand a lot more patience. These are the traders who are totally fine holding on to a position overnight, trying to catch bigger market moves that can take days or even weeks to play out.
And that brings us to swing trading. The name itself is a perfect hint. Imagine the market moving like a swing on a playground. A swing trader's job is to hop on while it's moving up or down, ride that momentum for a few days or maybe a few weeks, and then hop off before it swings back the other way. It's not about riding it forever. It's about catching one of those solid, profitable swings.
So if swing trading is about catching a single wave, position trading, well, that's about riding the entire tide. These traders are in it for the long haul. We're talking holding positions for weeks, months, sometimes even longer. These guys couldn't care less about the daily blips on the screen. They're all about the big picture, the major economic trends, or the fundamental health of a company that drives those long, powerful market movements.
And here you can see it all laid out, right? It's the perfect visual. You can literally see the journey we've taken, from scalping, measured in seconds, to day trading in hours, then swing trading over days or weeks, all the way to position trading, which can last for months. It's all about that time horizon.
Okay, so up until now, we've been sorting traders based on time. But that's not the whole story. Some traders are defined more by what they're trading, or the specific tools they use to do it. These are the specialists.
Let's kick things off with Forex trading. This is the massive global market for currencies. Now, a Forex trader could use any of the time frames we just talked about. They could be a scalper or a swing trader, but their whole focus is on the exchange rates between currencies. So let's say a trader thinks the euro is about to get stronger against the US dollar because of some big policy change. They'll make a trade to cash in on that specific move. It's a huge world driven by global economics and politics.
All right, next up, we have options trading. Now, this isn't really a market in itself. It's more like a super sophisticated tool. Options contracts can be used for all kinds of complex strategies, betting on which way a price will go, betting on how much it will move, or even just to generate income. And the risk? Well, it's all over the place. It can be insanely high or surprisingly low. It all depends on the strategy you're using.
And that brings us to algorithmic trading. This one isn't about what you trade, it's all about how you trade. Basically, instead of a person clicking buy or sell, a computer program is doing all the work automatically. Traders set up very specific rules, and the algorithm just executes them with a speed and discipline that no human could ever match. So yeah, you need to be a good trader and a pretty decent programmer.
So what does that actually look like? Well, it's a pretty clear process. First, you have to define super specific rules. If this happens, then do that. Then you program that strategy. And this is crucial. You backtest it on a ton of old data to see if it even would have worked in the past. And only if it passes that test do you unleash it on the live market to trade automatically.
Whew. Okay, we have covered a ton of ground, haven't we? From the sprinters to the long-distance hikers of the trading world and all the specialists in between. So now let's pull it all together and really see the big picture.
Think of this table as your ultimate cheat sheet. It puts everything we've talked about right next to each other. You can see so clearly that direct line between the holding time, the goal, the skills you need, and of course the level of risk you're taking on. It's just a great way to see, at a glance, the trade-offs you're making with each style.
And honestly, this is the most important takeaway of all. There's no such thing as the best type of trading, period. The strategy that's perfect for one person could be a total disaster for someone else. It's a really personal choice that has to match your personality, how much risk you can handle, the money you have to work with, and let's be real, how much time you actually have.
So, there you have it. We've laid out the map, we've defined the different paths by time, by tools, and by temperament. The real question isn't which path is best, it's which path is best for you. Are you the sprinter, the marathoner, or the long-distance hiker? Something to think about.